Well, we've got 6 of the best for you on the trade-off this week. US equities extending their gains with the S&P 500 closing north of 5,000 for the first time ever, as Chinese equities have experienced a little bit of a turnaround in what I would call a dead cat bounce. Meanwhile, Treasury yields continue to ratchet higher across the curve with new year-to-date highs in the 2- and 5-year, while the dollar gained ground last week for a 4th week in a row. A busy week awaits financial markets this week with US CPI, the standout event on a jam-packed data docket, while market participants also await a data deluge here in the UK as well. Plenty to discuss on the Trade-Off UK this week. Without further ado, let's get into the show. So a busy show as always this week, and as always joining me to try and make sense of everything that's going on is Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, 6 of the best in the intro. It's our 6th show of the year, and number 6 rings a bell from something that happened over the weekend as well, mate.
Yeah.
He's off. He's like the West Ham fans leaving at half time.
I'll tell you what, I was nearly at Reading by the time the whistle happened. So, I was out the door. Go on, have your glory. This, ladies and gentlemen, this is a typical Arsenal fan. Couldn't hear them, couldn't pipe up when we beat them early in the season in the league. Couldn't pipe up when we beat them in the cup. And now they scrape a lucky win. And, here we are. We're doing a whole show about it. So, Arsenal fans at their best, folks.
Well, I'm just waiting for Jamie Carragher to write in the comments down below that my celebrations are over the top because, the celebration police were out in force once again over the weekend. Right, why don't we get on to more serious matters because we do have plenty going on this week, and let's get into Topical Thunder. Right, so the first thing I want to discuss this week is Arsenal's dominance over their East London rival. No, that's not right. I want to talk about the US inflation data. And I guess first things first, we should cover off the CPI revisions that we got last Friday. Got to be one of the most overhyped events that we've had in financial markets recently. I think it was because the 2022 revisions that came out this time last year actually changed the inflation picture quite substantially and moved it quite a long way higher. The 2023 revisions made really no material shifts to the inflation outlook whatsoever. For those curious, the 3-month annualized core inflation rate, which is probably the most important thing you can extract from the data, remained unchanged at 3.3% in the last 3 months of 2024. And of course, the year-on-year data wasn't revised because it's non-seasonally adjusted anyway. So that all passed and was a bit of a non-event last Friday lunchtime, if we're being completely honest. This week's main event, though, should be a little bit more exciting, and that is, of course, the January US inflation data due Tuesday lunchtime. We're expecting a pretty chunky fall in the headline measure, down to 2.9 from 3.4% on an annual basis. That would be mainly due to some favourable base effects and also a continued drop in energy prices. When you strip out energy and food, core inflation should also continue to come lower, down to 3.7 is the consensus from 3.9% prior. So that immaculate disinflation, as it's being called, is looking set to continue. The US economy looks set for a soft landing, as data has been pointing to for some time now. But I guess the question I would ask you, Ryan, is how much can this one print significantly change the Fed policy outlook? Looking at market pricing, we've got about a 15% chance in the curve of a cut in March. You'd obviously expect that to come out on a hotter than expected number. But looking ahead to May, the market sees about a 3 and 4 chance that the Fed kick off their easing cycle then and is pricing about 40 basis points worth of cuts by June. I don't know about you, but I struggle to see how the market can actually alter that path too significantly unless we get a really cooler than expected number and we see that pricing come back into May, perhaps.
Yeah, I think it's going to be a case of deja vu for rate pricing. We had all the fuss and bother around March and that got knocked out. We're going to have the same thing about May. If we get a 2 handle on that year-on-year number, the headline number, then the market's going to, step up its cut expectations. Conversely, if we get a softer core number as well, then we're going to play this game all over again. I think the main risk is if inflation doesn't come down as fast as they expected or as the market expects, which will keep the stickiness in play. And we know what central banks like to do. The headline number can go down to 2%, but if that core is still at 3%, above 3%, that's the one they'll focus on. So, yeah, the core number is going to be important, but, I'd expect the market to move on the headline number. And, yeah, if it's sticky, then we start pricing out of May. And if it's not, then we start pricing in May all over again. And those expectations ramp up. Overall, I see no change. I still think it's going to be the middle of the year before they do decide to cut. They're going to give themselves more time to see all the data. They are in no rush. So the market's going to do its thing. The Fed are going to do their own thing.
Yeah, I think you're absolutely right. The Fed have been very clear. They want more data. They want confidence we're getting back down towards 2%. And, they've had 6 months of good inflation data. This could be a seventh. Is 7 months really going to make them cut straight away? No, absolutely not. As with all policymakers, they're looking for a trend. They're not looking at one print or another print. So, I'm sticking with my June call as well. In any case, why don't we move on? Because we're talking about inflation. I guess there's somewhere where deflation is becoming a real issue at this point.
Yeah, very much so. And China's the place for that as well. And we've had Chinese President Xi coming out, finally forced to step up to the plate regarding the slump in Chinese stocks. Last week, he was going to discuss stock markets with financial regulators. And that discussion culminated with the head of the Securities and Regulatory Commission losing his job. So that same commission then vowed to punish anyone caught manipulating stocks, which in this current situation looks like anyone who dares to sell them. Now, Xi's influence from there continued as the China Sovereign Wealth Fund said they're going to vow to boost ETF holdings and again try and put a floor into those stock market moves. Now, all this led to a decent rally in Chinese stocks, though if you look at the charts, they look awfully like a bit of a dead cat bounce. So while Xi might have sent the population into the Chinese New Year with some green numbers on their portfolios, it doesn't alter the fact that for the third month running, China saw negative CPI numbers, and that some Chinese analysts writing in the SCMPs, the South China Morning Post, saying that a helicopter money might be an option that they may have to turn to boost activity and get businesses expanding. So that's a final route for Xi if if policies don't stop this rot. So they're not inclined to lean that way at the moment, but if things continue to get worse, they could head that way. So stopping everyone from shorting the stock markets collapse. Stopping everyone from shorting may have stopped the stock markets from collapsing, but if there's no substantial buyers coming into the market, they're not going to rally significantly. And I think this reprieve is going to get severely tested when China return from the break.
Yes, I would tend to agree with you on that one, mate. Of course, China closed all year for the Lunar New Year holiday. Excuse me. It's just a bit of a farce at this point, really, isn't it? I mean, as you say, they're trying in vain, seemingly, to prop up the market. But ultimately, the way I'm kind of looking at things, I know the stock market is not the economy, but they seem to be getting right on the verge of getting stuck in this debt deflation loop. The property sector is in real trouble. The economy has not recovered in any way, shape or form from COVID. Momentum remains incredibly anemic. And then if you look from a sort of international institutional investment point of view, if you want exposure to Asia, why are you going to go to China, where the government is increasingly clamping down on private enterprise and bringing in new crackdowns on a sort of daily or weekly basis, when you can get the same exposure to those themes by going to Japan, where the Nikkei is 4% off an all-time high, or going to India, where the economy is performing significantly better, or Vietnam, where a lot of production has been moved to. I just cannot see a bull case for China at this point, and I think it is going to be another dead cat bounce, and the market will resume its trend lower. I think we've had 4 or 5 of these in the CSI 300 and in other Chinese markets over the last couple of quarters, and this is just going to go down as another one, I think.
Yeah, I think so too. We speak about China a lot on this show, and that's been my main thought throughout all this. You've got two sides. You've got the domestic side to it, which in fairness, China have the tools there to get the domestic economy moving and flowing, but then you've got this still decoupling, deleveraging from China from everyone else, and that's not going to help them internationally. So until they fix both parts of the of this equation, then I think they are going to be in for a rough ride in the months ahead.
Yes, I very much agree with you on that one, mate. Right, speaking of a rough ride, I guess you could say the same thing for the UK. I think it's going to be a bit of a choppy one here in Blighty this week. We've got plenty of economic data coming out. We've got labour market numbers due on Tuesday, so I guess they will actually be out by the time this airs. Personally, wouldn't put too much weight on them. Obviously, the ongoing data quality issues with the ONS, they were out over the weekend saying that it's now going to be September before they fully complete the new labour force survey, which means we're going a year without an accurate read on what's going on in the UK jobs market, which is quite frankly a joke. We won't spend too much time on those because of that, and also because of the fact that by the time you watch this, they will obviously have printed. So in terms of the rest of the week, Wednesday, we get the latest inflation figures. We're expecting actually some quite nasty and undesirable upticks in inflation for the second month in a row. Headline CPI is seen at 4.1% on an annual basis in January. That's up from 4% in December. Core also up 0.1% to 5.2%. And the services inflation number, which is a real focus for the MPC, that's seen, according to the Bloomberg consensus, rising to 6.8 from 6.4% previously. That would obviously be a pretty big worry for the BoE. But I would caveat all that by saying that there is a big rise in the energy price cap that comes into that data, which will skew it higher. And you've got some base effects involved as well. So a few moving parts. I don't anticipate it's going to alter the policy outlook too significantly. Moving through into Thursday, I'm trying to get through this as quickly as we can. We've got the fourth quarter GDP numbers. We're expecting a contraction of 0.1% in the last 3 months of 2023. That will be equal to the pace of contraction that we saw in Q3. And it would also put the UK into the mildest of technical recessions at the end of last year. Of course, that is not particularly great, but I'm not sure it matters too much to markets, given that the data is very, very lagging. And then on Friday, we get the latest retail sales data, and we're expecting a nice bounce in January, up about 1.5% on the month. But that's just because the December number was so cataclysmically bad, having fallen by well over 3% over the festive period, that sales almost just have to bounce purely for a mechanical reason, if nothing else. So I guess there's a couple of questions, and Ryan, I'll give them both to you because I'm feeling nice. The first one, out of all of that, what do you think matters most? And the second one is, perhaps more importantly, can any of that move cable out of this really turgid, boring and dull 126 to 128 range that we seem stuck in?
Yeah, I think, well, which one? I'm going to have to go for three things, actually. I think despite the jobs numbers... There you go. I've got 75% of them. Yeah, I think obviously it's going to be after people see the show, but those wages number are going to be important. If they ain't coming much higher, if they're much stickier than expected, then again, that feeds into the Bank of England. But yeah, inflation, it's been a bit of a theme. Those US numbers, they actually jumped up last month. I think it was last month. And now we expect them to come back down again. The ECB have been indicating that they expect inflation to maybe start ticking up a bit into the early part of the year before coming down again. I think the same thing's going to happen for the UK. We always know that inflation is going to be stickier in the UK, just the nature of the beast. And I don't think any of these numbers, unless it's an outright collapse in them, is going to change anything for the Bank of England. They're not going to start getting more dovish and talking about cuts again. The retail sales, again, I thought it might have been the other way. I thought we might have got a half decent number in December, just based on anecdotal evidence, and then the drop in January. But like you say, mechanically, it has to be a lot worse for numbers to come in negative than they were last month, which, being the UK, is always possible. So, yeah, we may get that jump.
I was the pessimist around it.
You'll see why later in my play of the day. But yeah, I think there is a risk whether the numbers do drop out of bed in January. January can be a funny month. People have a lot of spending into Christmas and that, and then it just falls off a cliff in January. So I wouldn't be surprised if the numbers are negative. But as you say, maybe a mechanical bounce. What can move cable out the range? or the pound in general, really, because we've got euro sterling still knocking around at 85 level. It's going to have to be sort of a double wind. So that's going to be either both UK weakness and US strength, or vice versa. I think that's the only thing that's going to move us out of the range. If one offsets the other, then I think we're going to be walking water the same. But this week is going to be important where we close the week, as opposed to what happens over the data, which can be volatile and we can move around quite a lot.
Yes, I think I would agree with that. The other thing I would mention just very quickly before we do. The other thing I'd mention just very quickly before we move on is we are blessed with plenty of BoE speakers this week as well. Green, Mann, and I think Andrew Bailey speaks a couple of times as well. So I'm sure all of our viewers cannot wait to see what pearls of wisdom they decide to impart on us over the next 5 days or so. But as you said, it is a very busy calendar elsewhere. So why don't you run us through that as well?
Yeah, Michael's mentioned obviously the US CPI data, but there's plenty more data to come. And what we want to look at here is whether we get this divergence in the data, whether it widens between the different economies. So particularly in the US, Thursday and Friday cap a big data slate this week. We get more puzzle pieces indicating the state of the US economy. Thursday's retail sales could be particularly important there due to one factor that I've highlighted. And that's last week, the December consumer credit data sort of fell off a bit of a cliff. In November, it jumped from 5 billion to nearly 24 billion in consumer credit, this is, and then fell back to 1.6 billion, far below the 15 billion expected last week. So there's been a bit of
Sorry, I must admit, when that data crossed, it's not something I ever normally pay attention to, but when it crossed Bloomberg, I thought, is that a typo in the headline or something?
Yeah, well, it was a big jump in November and a big fall back in December. So that to me shows that there may be a bit of credit used over the Thanksgiving and holiday period. People having a bit of a spend up and then quitting the borrowing later on, which again looks to be reflected in the November and December retail sales numbers, which were both positive. So given the pullback in that credit data, I think there's a bit of a risk of seeing the retail numbers coming in, far worse than the minus 0.1% expected for the headline, and also far worse than the 0.2, 0.3% gain for the ex-gas and ex-autos numbers. So if we do see positive numbers from the consumer, that will be yet more consensus-beating Goldilocks data, if you like. Now, on top of that, we start getting the first regional manufacturing data for February via the Empire and Philly Fed, which this month is all on the same day. Then on Friday, we get some of the main housing data via starts and permits. Now, given that the NBA data has been fairly strong throughout January and Feb so far, there's reasons to think that the housing market is going to fare pretty well at the start of the year. That's obviously weather permitting. Then later on Friday, we get the PPI numbers. And for me, that will sort of subtract or add to what we see from the CPI data. Maybe some icing on the cake is then the flash Michigan numbers, consumer sentiment numbers for February, which again add or subtract from what the retail sales have told us. So all that should give us plenty of volatility to trade those Fed rate expectations.
Oh, indeed. Going to need a lie down at the end of all that, aren't we? Or a beer, one or the other. Yes, it's busy week ahead.
So rude.
I think the two big things for me are retail sales control group, because it feeds into the GDP basket. I think that's the real key measure to watch there. And as you said, risks probably tilted to the downside. I think the Bank of America credit card data sends a similar message to the official consumer credit numbers you referenced. And the University of Michigan inflation expectations. I think the 1 year ahead fell to a 2.5 or 3 year low in the January survey. Was that a blip? Is that a trend? I think that's going to be very, very important and a big focus for Fed policymakers, but plenty for everyone to get their teeth into on the data docket this week. And we haven't even covered things like the Japanese GDP number or the Aussie job states that we got out on Thursday as well, which could be a key one for the RBA. In any case, let's move on to our That's a Setup. Right, so I want to start the segment that's called That's a Setup. Now I've got the name of it correct, with a look at the Kiwi dollar once again this week. This is something that myself and Mr. Blake Morrow from the Australian version of this show were looking at last week. And despite what Blake may have tried to tell you last week, it's not something that I jinxed, but we both seem to get this one quite spectacularly wrong. It happens. We are only human in the financial markets. And this is why risk management is the name of the game. You are never going to be right 100% of the time. In any case, having sat here this time last week and said, I think that all the risks is the downside for the Kiwi dollar, what happened? Well, it ended up as the best performing G10 over the last 5 days. And I think there were two main reasons for that. The first was the better than expected jobs data that we had last Tuesday. Unemployment rising to 4%, but that was well below the 4.3% expectation. And labour costs rising a much hotter than expected 1% in the final quarter of last year. On top of that, you then had ANZ coming out with what I would call a bit of a crazy forecast for the RBNZ, saying that they're going to hike twice more, up to 6%, with 25 basis point hikes coming in February and in April, and that helped the Kiwi dollar rally into the market close on Friday night. But despite all of that, I'm still not seeing much reason to be bullish on the Kiwi dollar. Yes, the labour market is a little bit tighter than we expected, but growth is still rolling over pretty rapidly. China remains a big issue, and the broader direction of travel for the greenback continues to point higher. I think the other thing to focus on from a technical basis is that the recovery we saw in the Kiwi dollar last week did somewhat stall out at the 61.50 level, which is the top of the recent range, and it's also the 38.2% retracement for people who are fans of those sort of things of the rally that we saw in the fourth quarter of last year. So personally, I would still play this from the short side. I think if we do get a clean break north of that 50-day moving average, which comes in around 61.85, so not too far to the upside, relatively tight stop, then I'd be definitively wrong and out of this one. But for now, I'm happy to stick with that bearish view on the Kiwi dollar.
Yeah, I think this one where you've got to match the news with the techs. Yes, things are looking a bit more bullish, if you like, and potentially tipping the RBNZ into a bit more of a hawkish tone. Like you said, ANZ coming out with another 2 hikes. So, yeah, that's all well and good, but is the price reflecting that? And looking at this one, it's still hitting its head on that level there. So until we start to get a break above there, then the news is pretty much, being washed aside and swept under the rug. But certainly I think this is a decent trend to watch, as I'm going to note in the next topic. But yeah, at the moment, yeah, similar situation to Cable. Are we going to get some Kiwi excellence, shall we say, that's going to keep it afloat against the dollar? But yeah, technicals wise, if it can't go up, there's only one direction it has to go.
Exactly that. Well, go on. You want to talk about the Kiwi dollar as well. We're both sort of fans of it this week, I think.
Well, we like to merge things together, keep a topic going. So I'm going to talk about
the
Aussie Kiwi
sometimes, isn't it?
Yeah. So yeah, I'm going to talk about Aussie Kiwi because I think it's a good divergence trade. We talk about divergence between economies, because surprisingly there are other countries and economies out there other than the US, which I like to point out to Mr. Blake Morrow now and again. That there are others other than the US. So if you want to diversify away from the US dollar, looking at other crosses can be helpful. So I'm sticking to this one, the Kiwi versus its closest geographical neighbour, Australia. Now, while New Zealand isn't one of Australia's top trading partners, Australia is New Zealand's second biggest trading partner after China. So there is some trade importance there. But mainly, though, this cross is good for capturing any monetary policy divergence between the RBA and the RBNZ. Now, as Michael just noted, the RBNZ may start to turn a bit more hawkish on the back of that recent data, and certainly market expectations are leaning a bit more hawkish too. That's compared to the RBA, which is firmly in the end of hikes and when do we cut mode. So naturally, Aussie Kiwi is seeing some downside, and we may finally be moving away from the magnet at 108, which for months the price has just seemed to gravitated to every so often. So if we properly break this 106 area, which is in the mix at the moment, it could lead to a move down to at least 104.70, 105, that zone down there, which perhaps would be a decent stretch point for these rising Kiwi rate expectations. Now, if we can't, then a move back to test the broken trendline levels can't be ruled out either. Now, the good thing about trading some of these types of crosses, the same as like euro sterling, is that they are often less volatile and the fundamentals are less noisy than trading, say, US dollar pairs. So while you may need a bit more patience waiting for moves, when they happen, you usually have plenty of time to position for them or indeed get on them and ride them. So, yeah, a good one to look at for just a small look at monetary policy divergence there.
Indeed, and I think that's a very good point. Although I would say Aussie Kiwi and Euro Sterling, they're both quite good if you suffer from insomnia. Give those a watch over a really, really long time period and you'll be asleep in no time whatsoever. Aussie Kiwi has been stuck. I pulled this up on Bloomberg before we came in because we do prep this show, believe it or not. Aussie Kiwi has been 103 to 113 since 2014. Which I think is the definition of range bound. Now, of course, there's been vol within that range that you can play, and we may have more of that on the cards here. But, fundamentally, I think very similar to Euro Sterling. As much as we would hate to admit it, the Eurozone and the UK economy are pretty similar. And it's no surprise to see the Aussie and the Kiwi currencies as well trade in a relatively flat nature over a prolonged period of time.
Yeah, absolutely. But, sometimes that low volatility is good for trading because, as I say, it gives you the practice in patience.
Indeed. And patience is a virtue, as my father told me while I was growing up. Whether or not I ever learnt that virtue, I will leave that up to others to decide. In any case, let's move on to the euro. We've spoken about the common currency quite a lot lately, but I want to speak about it once more. And the reason for that is because we closed below the 100-day moving average at 107.90 on Friday. And that is the first time we've closed below that level since all the way back in November. You will see on the chart there that we did have a brief probe of that level to the downside in the middle of December, but it held on a closing basis each time. And I think it's interesting that we closed below that level last week. We had a bit of dip demand come in around 107.25, but price couldn't reclaim that 100-day moving average into the close on Friday. And to me, that suggests that the balance of risks here remains tilted to the downside from a technical perspective. And it's the same thing from a fundamental perspective. I don't need to rattle off all the reasons why I'm bearish on the Eurozone, but I think what's interesting is the amount of dovish ECB rhetoric seems to be picking up just a little bit. A few policymakers out on the wires over the weekend touting the possibility of cutting rates a lot sooner than the summer timing that Lagarde and Lane and de Guindos have been flagging relatively recently. And when you consider how grim the growth outlook still is, particularly in Germany, and also that disinflation seems to be going ahead a lot faster than people have been expecting, I think the April ECB meeting, where markets priced just 12 basis points of easing, is pretty underpriced at this point. And when you then throw on top the fact that the US economy seems to be cruising towards a soft landing and is undergoing this Goldilocks narrative at the moment, I think you've got a pretty strong bear case for euro dollar still. And I reckon we're going to get below 107 in relatively short order. And I don't want to bring it up again, Ryan, but, we did have the 105, 111 thing and another week where we're moving close to my target and further away from yours, I'm afraid.
Oh, here he goes, crowing again. Okay, it's a marathon, not a sprint, mate.
Tortoise in the hair and all the rest of it.
Yeah, that 107 level is still key for me. We pulled up short of it last week, 107.25, so we couldn't even tap it. Since then, we've had a move up to 108, a bit of a pullback. At the moment, every time I've looked at this pair today, it's trading 107.70. So for now, it's not really moving anywhere. Yes, it's a bit of a coin toss, this one. We've stopped falling for the moment. That hold in the low 107s has done the trick, and we've made a higher low from that. So that shows that support is coming in off that low. So got a bit of work to do to bust back down to the downside. Again, the US data could do it this week. There's very little Eurozone data. I think we've got German zoo and we've got GDP numbers, but apart from that, there's not much else. So this one's going to be at the mercy of what the dollar does. So again, we could break that 107 level quite easily on very strong US data. Where it closes the week is going to be, again, key for me. If we have a move under, but we get back above and we close a week back above 107, then we're still in the range. But that would tell me we've perhaps finished dropping for now. We've done nothing but fall since the new year. So, yeah, as I say, it's 50-50 which way this one goes. And if you're trading it, that's fine. You just go with the breaks. If you break up above 108, then maybe we go back towards 109. If we properly crack 107, then you might get your 105 at some point.
No Eurozone data this week, but we do have 14 ECB speakers, which I'm sure we are all incredibly excited about. Right, our last chart this week is an episode of Art Attack, because Ryan has had his crayons out. I mean, what on earth is going on here, mate?
Oh, dearie me. Well, I'm surprised you didn't pull up the S&P when I saw the notes today. I
didn't think I was allowed anymore.
Well, I thought you were going to have it in every topic this week, but no. So the blank space was there, and I filled it in. And as we have with markets that make new highs and historical highs, everyone wants to know where's the top going to come in. So the S&P continues to break new ground. Everyone, as I say, looking where's the top, where's the top. Because there's often a fixation among inexperienced traders to always fade a big move, whether that's trying to sell tops or buy bottoms. And when that doesn't work, what happens is that usually traders then realise they should have been going with a trend all along. So they start chasing the move, which, again, usually ends up, in this case, buying at the top and getting caught out on that side. So throughout this S&P move, and we've spoken about here and elsewhere, I've tried to show why purely watching the price action can tell you why a move might continue and when it might turn. So firstly, this move has shown no signs of stopping since the 4,800 break. So we need that pattern to change before thinking about a top. Now, so far, tops have not lasted longer than a day or two, and that's the first big signal that we're going to keep going. Second, the pullbacks are becoming more and more shallow. Now, what I want to see is a high that lasts, firstly, longer than 3 days, and I've circled that period before the 4,800 break. That level was solid resistance for several weeks. The top was strong and it gave shorts decent reward until the break happened. Then late January, we had that decent trend refreshing pullback of some 90 ticks after the 4,900 break. And that's healthy for a trend. But since then, the refreshes have been very shallow. And that means two things. One, patience for dips is wearing thin and people are now chasing any dip they can get. And two, it means that when it does turn, those chasers are going to be the first to bail, which will then likely lead to a bigger drop. And when that happens, all the patient dip buyers will come in and hoover it up, likely meaning we then keep going higher. So if you want to go long, wait for the chasers to get flushed out. Look for the potentially strong support levels, which right now are at 4,900.05, 48.45 and 48.0020. And if you want to go short, wait for proper evidence of a top. But remember, you don't have to catch the topmost high print, but anywhere close to a well-defined top is where you're likely to get reward from.
Indeed. Very well said. I'm feeling slightly nasty, so I'll ask you this. We're at 5,000, as near as makes no difference. We'll use the Pepperstone contract closing price there, 50.30. Where's the next 200 points? Is it 4,800 or is it 5,200?
Where is it? Well, I'm going to talk my book because I'm still long and I keep buying the breaks up top. So I'm going to go 5,200.
There you go. We got two bulls. I am in exactly the same camp as you.
Oh, in that case, I'm going 4,800.
I knew you would do that. Right. While I go and swear at Ryan, let's roll the titles for our plays of the day. Right, I want to talk about gold this week. I know Ryan brought this up last week, and I'm going to be very honest because I don't really see the point of gold at this point in time, or ever, really. I've never quite understood the luster of the yellow metal as a safe haven. It's certainly not the inflation hedge that people claim it to be. But in the current environment, when you think about what's going on, we just looked at the S&P. We've both sat here and gone, the next 5% is likely going to lead us higher. Risk is rallying pretty hard, both in the US and in Europe, and obviously we've seen a bit of a bounce in China as well. Rates ratcheting higher across the Treasury curve, both nominal and, importantly, real rates moving higher as well. And the dollar continuing to gain ground, 5 of the last 6 weeks higher for the greenback. And there's really nothing else in G10FX that's really worth buying over the long term in my mind. So when you look at all of that, it's pretty tough to build a bull case for the yellow metal in my mind. Add in the fact that we are testing this trend line that's been in place since kind of mid-December. If we break below that to the downside, then I will be looking to get short initially for a move towards the 2,000 figure. That is obviously going to be big psychological support to the downside, but I wouldn't be betting against a test down towards the 100-day moving average in an ideal world, which comes in around 1985. Ryan, what are you? Oh, you're looking at cable this week, I see.
Yeah, this one should please you, mate, because I'm looking on the short side, and I'm looking to play the play the difference here. This play of the day is more about the weight difference between the UK and US. As we said, we've got a ton of data out this week, and I want to look at the short side on any decent rallies in cable. And this is purely because if the good US data keeps coming, it will outweigh the good news on the UK side. We'll have to see if the data from either side can significantly kick us out of this 126.28 range. But I'll be looking to sell rallies perhaps into the high 127s or 128, as long as there's no horror stories from the US. So while this one might present opportunities over all the data points, one can also look at it again on a closing basis at the end of the week to see how things have settled. And if we've settled in the high zone, then either something's changed or I'll be ready to get in with shorts.
Good stuff. And you've got 6 seconds left on the clock as well. Expertly done. Right, that does bring us to the end of another episode. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining us. We can let him go back to the counselling sessions he's receiving after that distressing performance on the football pitch yesterday. Off he goes. Thank you very much, as always, as well, to our producer, Kyriakos, for bringing this together as brilliantly as he always does. All three of us will be back with another episode of The Trade-Off this time next week. We hope you can join us then. In the meantime, thank you very much, as always, for watching. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, or if you've got any tips for getting over grief that Ryan could use. And all three of us will see you again in next Tuesday. Thanks as always.
I'm going to say, you better not lose a game for the rest of this season, or I'm coming back at you every week, mate.
Oh, I'm sure you are. We'll see you then. Take care.